Mark Rudovic, head of real assets at Hodes Weill. Um, Hodes Weill focuses on private capital advisory, so capital raising and other GP advisory, so GP to GP M&A, et cetera. I'm based in New York, run the real assets group. Real assets as we define it, infrastructure, natural resources, et cetera. And my firm, given where we sit in the industry, we publish annually an Infrastructure Allocations Monitor. And this year, we had roughly 102 LPs participate across 22 countries that represent north of 8 trillion in assets, and of that, 350 billion in infrastructure AUM. The intention of the report is to track LP preferences to infrastructure as an asset class. So sectoral preferences, geographic preferences, risk preferences, and even tracking things like investor returns year by year and on a 3-year trailing average. So I'm happy to get into some of the findings. So just to kick it off as a headline, we saw target allocations to infrastructure grow from 5.1% to approximately 5.5% in 2024, which represents in AUM terms roughly half a trillion in AUM. When thinking about target allocations by geography, we found that Canadian institutions had the highest target allocation at 12.6%. And interestingly, their neighbors in the US were at a target allocation of approximately 5.4%. What we look to assess is how underallocated are institutions to infrastructure as an asset class. And we found in 2024, institutions were approximately 123 basis points under their target allocation. Nowhere was that underallocation more pronounced than EMEA, where institutions were underallocated to infrastructure by approximately 160 basis points. In terms of investor preference by geography, we found investors preferred the home market in 2024. And when you think about 2024, it's the biggest election year on record. And we found from comments by investors to this report that there was a preference for the home market to avoid regulatory risk, any political risk. So globally, the preference for geography was North America, but we saw an uptick in EMEA investors preferring investment in EMEA and North American investors preferring an investment in North America for 2024. We ask investors where they intend to allocate more capital to, less capital, and where they are considering but not yet invested across 4 infrastructure verticals. The 4 infrastructure verticals being digital, energy, transport, and social infrastructure. And in 2024, the preference by institutional investors and where they plan to allocate more capital to is in digital infrastructure for the second consecutive year. We ask investors to dig further on the energy vertical, just given how large the ecosystem is in energy and the various subsegments. And there we found institutions plan to allocate more capital to renewables and storage more than any other subsegment of energy. And that's inclusive of oil and gas, midstream, LNG, and right behind preference for the highest preference for renewable energy and storage was a preference for energy transition 2.0 technologies, such as carbon capture, green hydrogen, things of that nature. So interestingly, when you compare demand for or preferences for renewable energy and storage versus digital in isolation, actually investors are looking to allocate more to renewable energy and storage compared to digital as a vertical. So globally, we found that institutions are preferring value add and core plus infrastructure strategies, and nowhere is demand for value add more pronounced than North America. And that is consistent with prior years. But we're seeing an uptick in interest in value add strategies from areas in EMEA and APAC. Interestingly, when looking at core in isolation, we found year over year that public pensions and their appetite for core exceeded insurance companies for the first time. So that was a notable change year over year. One of the more interesting elements of this report is where we track returns of institutional investors in infrastructure. When you think about infrastructure as an asset class, one of the things that has plagued the asset class since inception has been benchmarking. We ask investors to provide returns for each year in isolation, and that way we can look at performance by year and also look at performance of infrastructure on a 3-year trailing average. And returns in 2023 tracked at roughly 7.1%. But I think more notably, when you look at the 3-year trailing average, returns were approximately 10.1%, which exceeded the target return by those same investors. That was roughly around 9.2%. So clearly, infrastructure has outperformed the target returns, what has been a very challenging market environment when you think about rising inflation, rising interest rates, in a global environment where you have supply chain constraints. So the infrastructure asset class we found through returns is doing what it's set out to do. So Hodes Weill has been producing an allocations monitor for the real estate asset class for over a decade. And part of the report talks about conviction and sentiment towards the asset class. So real estate, infrastructure, and in 2024, sentiment to infrastructure and a conviction in infrastructure was the highest on record across both infrastructure and real estate. So clearly, there is interest and demand for infrastructure, a curiosity for infrastructure that will remain over the near to medium term.